Welcome to the Beginner's Guide to Stock Market Investing. If you've ever felt overwhelmed by the idea of investing, you're in the right place. This video is designed for absolute beginners, providing a clear, step-by-step roadmap to navigate the exciting world of stock market investing. By the end of this guide, you'll have a solid foundation to start building your financial future with confidence. So what exactly is the stock market, and why should you even consider investing in it? Simply put, the stock market is a place where shares of publicly traded companies are bought and sold. When you buy a stock, you're essentially buying a tiny piece of that company. Why invest? Historically, the stock market has been one of the most effective ways to grow wealth over the long term, helping your money work for you, rather than just sitting idly. Before you even think about buying your first stock, the very first and most crucial step is to set clear financial goals. Are you saving for a down payment on a house, planning for retirement, or perhaps looking to fund your child's education? Having specific goals will influence your investment strategy, risk tolerance, and the types of investments you choose. This isn't just about throwing money into the market. It's about aligning your investments with your life's aspirations. Once you have your overarching financial goals, it's important to define whether they are short-term or long-term. Short-term goals, like saving for a vacation next year, might require less volatile investments or even just high-yield savings accounts. Long-term goals, such as retirement planning 30 years from now, give you the luxury of taking on more risk, as the market tends to smooth out over extended periods. Understanding this distinction is vital for choosing the right investment vehicles. Next, you need to understand your personal risk tolerance. This is a critical self-assessment. How comfortable are you with the idea of your investment value fluctuating or even temporarily decreasing? Someone with a high risk tolerance might be comfortable with more aggressive growth stocks, while someone with a low risk tolerance might prefer more stable, income-generating investments like bonds or dividend stocks. There's no right or wrong answer here, only what's right for you. Be honest with yourself about how much volatility you can handle without losing sleep. With your goals and risk tolerance in mind, the practical next step is to open a brokerage account. This is essentially your gateway to the stock market, acting like a bank account, but for investments. You'll deposit money into this account, and then use it to buy and sell stocks, bonds, mutual funds, and other investment products. Think of it as your personal investment hub. There are different types of brokerage accounts, and choosing the right one depends on your needs. The most common are taxable brokerage accounts, which offer flexibility but require you to pay taxes on capital gains annually. Then there are retirement accounts like IRAs, individual retirement arrangements, and 401ks, which offer significant tax advantages for long-term savings, but come with withdrawal restrictions. Understanding the differences is key to optimizing your tax situation and financial plan. Choosing the right broker is almost as important as choosing the right investments. You'll want to consider factors like fees, some offer commission-free trades, the range of investment products available, the quality of their research tools and educational resources, and customer service. Popular online brokers include Fidelity, Charles Schwab, and Vanguard, but many others cater to various investor needs. Take your time to research and compare before committing. Before you start picking individual stocks, it's crucial to understand some investment basics. This includes fundamental concepts like market capitalization, earnings per share, EPS, price to earnings, PE ratio, and dividend yield. These metrics help you assess a company's financial health and valuation. Don't worry, you don't need to be a financial wizard, but a basic understanding will empower you to make more informed decisions. Let's demystify some common investment vehicles. Stocks represent ownership in a company. Bonds are essentially loans to governments or corporations, offering fixed interest payments. Mutual funds are professionally managed portfolios of stocks, bonds, or other assets, offering diversification. Exchange-traded funds, ETFs, are similar to mutual funds, but trade like individual stocks on an exchange. Each has its own risk and return profile, and a balanced portfolio often includes a mix. Two golden rules of investing are diversification and asset allocation. Diversification means not putting all your eggs in one basket. By investing in a variety of assets across different industries and geographies, you reduce the impact of a poor performance by any single investment. Asset allocation refers to how you divide your investment portfolio among different asset classes, such as stocks, bonds, and cash. This strategy is tailored to your risk tolerance and financial goals, and it's a cornerstone of long-term success. When you're ready to pick individual companies, there are two main approaches to research: fundamental analysis and technical analysis. Fundamental analysis involves looking at a company's financial statements, management, industry, and economic outlook to determine its intrinsic value. Technical analysis, on the other hand, involves studying historical price charts and trading volumes to predict future price movements. Many successful investors use a combination of both. Developing an investment strategy is about defining your personal approach. Value investing, popularized by Warren Buffett, focuses on finding undervalued companies. Growth investing targets companies expected to grow faster than the overall market. Dividend investing focuses on companies that pay regular dividends, providing a steady income stream. Your chosen strategy should align with your goals and risk tolerance. It's not about jumping on every trend, but about having a disciplined plan. It's a common misconception that you need a large sum of money to start investing. The truth is, you can start with a surprisingly small amount. Many brokers have no minimum deposit requirements, and you can buy fractional shares of expensive stocks, meaning you can invest just a few dollars at a time. The most important thing is to just start and build the habit. Small, consistent investments can grow significantly over time due to the magic of compounding. One of the most effective strategies for beginners is dollar-cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market fluctuations. For example, investing $100 every month. When prices are high, your fixed amount buys fewer shares, and when prices are low, it buys more. Over time, this strategy averages out your purchase price and reduces the risk of trying to, quote, time the market, which is nearly impossible for even seasoned professionals. A crucial rule of thumb in investing is to only invest what you can afford to lose. While the stock market offers significant growth potential, it also carries risks. There will be ups and downs, and there's no guarantee of returns. Ensure you have an emergency fund saved up, typically 3 to 6 months of living expenses, before you start investing. This way, you won't be forced to sell your investments at a loss if an unexpected expense arises. To recap, we've covered setting financial goals, understanding risk tolerance, opening a brokerage account, grasping investment basics, diversifying, researching companies, developing a strategy, and starting small with dollar-cost averaging. Remember, investing is a marathon, not a sprint. Be patient, stay disciplined, and continue to educate yourself. You've taken the first brave step by watching this guide. Now go forth and build your financial future.